Welcome to the Mistake-Free Real Estate Podcast. I am your host, Mark Lautour, and we've got a great show in order for you today. I'm joined by Sarry Ibrahim, who has his MBA out of Chicago. Sarry's business is really to help high net worth individuals, so this is really going to resonate with our listeners today. He helps real estate investors, business owners, and retirees grow and protect their wealth predictably and safely. Sarry, welcome to the show.
Hey, Mark, thank you so much for having me on. I appreciate it.
So, mate, let's start off with, what is infinite banking? Describe that to our audience.
Yeah, definitely. So it's kind of a counterintuitive approach. The infinite banking concept, also known as the bank on yourself concept, is pretty much using dividend paying whole life insurance, mainly for the cash use for the living benefits, to be able to fund real estate, to finance your business, or to pretty much do anything you would do with cash otherwise. So it's pretty much, for those not aware, whole life insurance has two aspects or two parts. One is the life insurance part, and the other is a cash value. We're talking about growing the cash value and then using that cash value over and over again for real estate investing, for your business, for anything else you want. That's kind of, in basic terms, what this infinite banking concept is.
So it's kind of like overfunded life insurance. Is that fair?
Yes, correct.
So you're overfunding it with the idea that you're putting it into an account that then you can use to pull out and invest in other ways and effectively borrow from yourself. Therefore, you call it bank on yourself.
Exactly. Yes, precisely.
So who are your clients? What are the people? Who are the people that you've seen successfully implement this in their business practices?
Yeah, so I've seen this mostly with real estate investors and business owners, and there's a couple of reasons why. So a lot of real estate investors and business owners, essentially real estate investors most of the time are business owners, right? So it's safe to say business owners have this kind of need to grow cash reserves, to grow liquidity, but also to take advantage of real estate deals or to other types of business. So it kind of creates this dilemma, what do I do with this money? Do I have it sitting in a bank account, or do I have it moving into real estate or other places? And then both are true, right? Because you don't want, as an investor, as a business owner, you don't want cash sitting in places not earning you any interest, because there's inflation and other risks. You want it to be moving for you and working places for you. But at the same time, you don't want it to be working in places that are not easily liquid or easily accessible, where the cash is easily accessible, because you may need that. So this strategy addresses both those things. You can have your cash sit somewhere that earns compound interest and dividends from the insurance company that it's with, and it's liquid. You could borrow against it, use that to finance real estate, either through down payments, or to actually finance entire deals using your policy. So this way it gives you the cash to use and access to it at the same time.
So that was one of my questions, is you can leverage. So would a mortgage company consider this cash down payment rather than borrowed money?
Yeah, exactly. Yes. So if, for example, you need to put down $100,000 as a down payment, you could borrow that from your policy, and it would be seen as using your cash from another bank account. Even though you borrowed it technically from an insurance company, the fact that you're leveraging it by your whole life insurance policy, it's looked at or viewed as your cash.
So this is a wonderful technique, guys. Sarry is really opening our eyes to something that is quite commonly used in the investment world, but only by those really savvy investors. It's something that you should consider as being part of your portfolio.
Mm-hmm.
I've actually implemented this strategy and started overfunding a life insurance policy myself, and haven't actually used it on the back end. Sarry, where do you typically see the break-even point? When can you start? I know it's kind of a turtle wins the race. This is not like an overnight, fund it, immediately draw it back out. When do you see the functionality or the actual usage of these funds becoming available to be used down the road? Is it a 2-year, 5-year plan? What's the normal strategy?
So the overall strategy is a long-term strategy. We're talking, 10, 15-year strategy. However, depending on the funding amounts of the policies, I've seen people use these policies, 3 months later after funding, because they've used larger amounts to fund the policy, and therefore they have larger cash values, because the cash values are somewhat proportional to the premiums that you're putting into it. Now, if somebody's, for example, still younger, maybe like they're 30 years old, they're allocating like $1,000 a month to a policy, it might take them a few years to actually be able to use those funds for real estate investing. So typically we see the break-even point around probably year 3.5 to year 4. That's when the cash value starts to meet what you've been putting into it. And then of course you could at any point borrow up to 90% of the cash value in the policy and still have the cash growing in your whole life policy without it being interrupted by the outstanding loan.
And there's no penalty. Like, can you borrow it for a long? There aren't periods of time that the bank requires you to put the money back in. Can you borrow it for a 10-year loan, a 2-year loan, a 6-month loan?
Yeah, exactly. You could borrow it for whatever you want and for however long you want it to be. We have a calculator that we show clients. Like if they borrowed X amount of dollars in this year, by this year they would have paid back X amount, in interest plus principal back to the insurance company. And then we compare that with their life insurance policy to show them the growth. And typically what we aim to do is we aim to have the policy outpace the loan cost. This way the cost of capital becomes cheaper to use your whole life insurance than it does to actually borrow the money from somebody else or even use cash. Because if you just simply use cash to finance deals, you're going to lose the opportunity cost on that cash had you had it invested somewhere that could have earned you interest. And then vice versa, if you borrowed from somebody else, you would pay the interest to them and lose that opportunity cost. So rather, if you have it in your policy, you could leverage the policy, borrow against it, and then recoup that interest while you're still using that money, while it's still being applied to different areas.
So if someone doesn't have life insurance, this would obviously be a wonderful tool for them because it obviously, I mean, we've talked about the cash value portion. This has a large, typically when you're overfunding a life insurance policy, these are large, $1 million plus life insurance policies typically, correct?
Yeah, correct. Mhm.
So that would be another strategy to utilize there also. What was your background? How did you get into this? Were you in the insurance business previously? How did you get introduced to this infinite banking concept?
Yeah, so I started in the insurance business in 2016 when I was in grad school, right before finishing up grad school, and I pretty much found out about this. Sorry, I was working at Allstate Insurance, and then I jumped into the healthcare field where I was doing more like Medicare consulting, and I was helping a lot of people who were like 64, 65 years old, retirees, and helping them merge from their employer plans to their own individually owned Medicare plans. So I was like their Medicare broker. And I started to build a good relationship with these clients. And one of my clients asked me if I could help him with life insurance. And he mentioned, there's cash value that builds up over time. And I wasn't really familiar with life insurance at that time. I had my license, but I had mostly done healthcare and Medicare stuff. And I told him I'd do research for him. I'd get back to him. And I went to Amazon and I searched for books about life insurance. And then that's where I found the book, The Bank on Yourself Revolution by Pamela Yellen. So I read that book, and then there was a section in the book that asked if you wanted to be a financial advisor to join the community. So I did. I applied, joined the community, went through an 8-week rigorous training program, got my Bank on Yourself professional license, and then after that, I started to read other books like the Becoming Your Own Banker by Nelson Nash, and all these wonderful books that talk about using the strategy. And again, it's not just life insurance; it's a way to hang on to the money, to keep the money that you're actually earning, and to have it grow over time predictably. So I'm not so much, anti-stock market, but I do think there are better ways out there to grow wealth and to have it compound for you over and over again. And if you could do it while also having life insurance, I think it's like a win-win. There's multiple functions and multiple purposes for using this. So I think it's not only beneficial for real estate investors, it could even be beneficial for people who are like full-time employees. Somebody who, for example, works at a not-for-profit organization or works for a company, they might have like a 401k or 403b in place, some sort of retirement plan in place. They could also have this alongside their retirement plan. So this way it kind of create more predictability and guarantees for their future, because you never know what's going to happen in the stock market. Thus, if your retirement account is in the stock market, I don't necessarily see that as being wise. I think that your retirement should be the safest place. It should be the least volatile place, regardless of your age. It should be the least volatile place, and using the strategy could be wise in the sense of building up cash for retirement.
So we're in a historical time in our nation's history, financially, right? I mean, in many different ways, but financially, we're seeing the lowest interest rates we've ever seen before.
Mhm.
Are the life insurance companies still paying out a fair interest rate? And what are the typical minimum on a whole life policy? Are you still getting like a 4% return on your money?
Yeah, good question. So typically the cash value in the policy grows two ways. It grows through interest and it grows through dividends. The dividends aren't guaranteed, but we only work with insurance companies who have been paying out dividends for over 160 years, regardless of market conditions. They've been paying out these dividends. So the dividends and interest together have a compounding effect, meaning the more compound interest you're earning, the more dividends you get. And then the more dividends you have, the more interest you earn. So they kind of spiral together. Typically, we're seeing about 5 to 6% every year with the dividends and interest combined together, even in this low interest environment.
Strong. I mean, so, gosh, if you're going to put your money in a bank or, literally, so when you say build the bank or be the bank, I think it's a pretty solid option for those out there that are sitting on cash. And you would probably agree, Sarah, we've never seen a time in our nation's history where people are so liquid. I know that COVID is taken its toll on a lot of people and, health and the prosperity of those that are less fortunate. But I have seen in high income, high net worth individuals, so liquid that they're having trouble, again, rich people problems, but they're having trouble even finding ways to deploy their capital. What are they going to do with it? This would be a great avenue for people to do so. Let me ask you this. As you know, the podcast is called Mistake Free Real Estate, very much tongue in cheek. Sorry. What we do here at SBD is we help full turnkey investors, high net worth individuals that are looking to get into real estate, do it mistake free, because we have made all those mistakes in real estate so other people don't have to. What are some of the mistakes that you see people making in investing, Sarry, that you try and help people avoid and not make those same mistakes?
Yeah, one problem or mistake I see is a lot of people follow the news as like a source of information for investing. And I think that's the least reliable place to find out investing information. Those are sales and marketing techniques aimed at convincing people to invest in certain areas. We saw what happened with GameStop, and that wasn't just one example. Was just one example of the media playing into influencing people. So I don't think that following the news and following social trends is a safe place or has safe information to investing. I think you should have an investment advisor, somebody who's competent in different markets and understands risk, of course, and is conveying that risk to you. That's one big mistake I see with people investing.
No, I'm a firm believer in partnerships and collaboration. And I think this would be an opportunity. Again, some people might say, oh, great, let me go do a whole life policy all on my own. Look, hey, there's an expert sitting here in front of us that has been there, done that. So I love your point. The news, I've taken Facebook completely off my phone. I've now, choosing which sources to get my news from very, very carefully. And quite frankly, not watching any of the local or national news. It's just, it's just, as you said, sales and marketing propaganda for the most part, especially in an election year. So thank you for bringing that to our attention. Hey, lastly, if people want to get in touch with you, Sarry, what's the best way for them to do so if they have interest in pursuing further?
Yeah, they could go to our website. It's finassetprotection.com, FIN, assetprotection.com. And if listeners reach out, I'll send them a free copy of Becoming Your Own Banker by Nelson Nash. It's the book about the infinite banking concept. I'll send it to them for free if they just reach out and ask for it.
That's wonderful. Hey, thank you so much. This has been an enlightening podcast. Really appreciated you sharing the wisdom with our clientele. And thank you for your time today.
Thank you so much, Mark, for having me on. I appreciate it.
You're listening to Mistake Free Real Estate Radio, the authority in passive real estate investing. No late night calls, no clogged drains, no tenant nightmares. Take the passive investor's approach to real estate investing and trust a turnkey professional. Learn more at mistakefreerealestate.com. Until next time, remember, you don't get rich from what you earn, you get rich from what you own.